Apple is one of the most talked about companies on the planet, and you do not need to own a single share to trade it. That is where CFDs come in. A contract for difference is an agreement between you and your broker. You are not buying the actual stock. You are speculating on whether the price will go up or down. If you think Apple will rise, you open a buy position. If you think it will fall, you open a sell position. Your profit or loss is based on how far the price moves and in which direction. One of the real advantages here is the ability to go short to profit from a falling price. Traditional stock investing makes that complicated. With CFDs, it is straightforward. CFDs also use leverage. That means you only put up a fraction of the total trade value to open a position. Leverage amplifies your gains, but it amplifies your losses too. A small move against you can wipe out more than your initial deposit if you are not managing risk carefully. Only trade with money you can afford to lose. Now, before you trade anything, you need to understand what moves it. Apple reports earnings 4 times a year. Those quarterly releases, covering iPhone sales, services revenue, and forward guidance, often cause sharp price swings. Traders watch these dates closely. Broader market conditions matter too. Interest rate decisions from the U.S. Federal Reserve, inflation data, and general stock market sentiment can all push Apple's price around, independent of how the company itself is performing. Apple is a major component of the S&P 500 and the NASDAQ 100, so when those indices move, Apple often moves with them. Product launches, supply chain disruptions, and regulatory news are also worth tracking. These events have historically triggered significant reactions in the stock. When it comes to analysis, most traders use 2 approaches. Fundamental analysis looks at the company's financial health, revenue, margins, competitive position. Technical analysis reads the price chart, looking at patterns, moving averages, support and resistance levels, and indicators like the relative strength index. Many traders use both. Fundamentals to form a directional view, technicals to time the entry. Risk management is non-negotiable. Set a stop loss on every trade. A stop loss closes your position automatically if the price moves too far against you. Most experienced traders risk no more than 1 to 2% of their account on any single trade. That discipline is what keeps losing streaks from becoming account-ending events. Also, be aware of swap rates, overnight financing charges that apply when you hold a CFD position past the daily rollover. They add up. Here is the practical takeaway. Before trading Apple CFDs with real money, spend time on a demo account. Study the chart on daily and 4-hour timeframes. Practice setting entries, exits, and stop losses. A demo account at ZenithFX.com lets you do exactly that, using real market conditions without putting capital at risk.